Hello and welcome to the Moving Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, we're kind of talking about, as I'm calling it, the tariff crash in 2025 and kind of the terrible conditions that have played out over the last few days, and really kind of looking near term and looking ahead to what to watch for overall.
Yeah, Jared. So I think kind of as you mentioned, the tariff crash of 25, you saw um, markets sell off very aggressively as the tariffs were announced and put in place, and really has had a significant impact on U.S. markets as well as international markets in the first day of trading since on Monday, and a number of commodity prices have come lower. You've seen oil go below 60. You've seen interest rates move lower, which provides some benefits, but comes in a very challenging environment. So let's talk about, I guess, some short-term actions that we've taken and how we're looking ahead, where opportunities may be, and what are some of the best ways to protect the portfolio.
Well, if you look, I think it's a good reminder, as difficult as it is, that the stock market's always a leading indicator. So right now, a lot of what you're seeing with the stock market is trying to price in how big a slowdown is ahead, right? And the reality is, at this point, best guess is we're already in a recession, right? First quarter following kind of where GDP is from the Atlanta Fed, we're in the negative 2 to 3% range. And as you've seen over the last few days and really a couple of weeks at this point, there's just a lot of frozen behavior between individuals, consumers, businesses, countries, just kind of wait and see. And the challenge with that is it's pretty dramatic on economic activity in the short run. So the likelihood of avoiding two negative quarters of GDP at this point seems very unlikely unless there's a dramatic shift. So as you look at the stock market performance, and as bad as it's been, that's really what's happening, at this point, is trying to price, S&P hit a bear market today, which is a 20% decline from its high. How much more is there to go, which is on everybody's mind and kind of the markets. And really, to me, that'll be determined by the economic data, looking at how long this kind of freeze and uncertainty persists. The longer it does, the likely, longer or bigger the slowdown will be, right? So as far as precautions, at this point, we raised, some cash ahead of this in March, but looking at times like this, it's hard to, not with the benefit of hindsight, you don't have enough, right? And trying to price things out. But as I always talk about kind of crisis investing, to us, it's always helpful to have some liquidity in your portfolio for two reasons. Number one, to protect in times like this. And number two, there is a lot of opportunity in this market at this point. But the challenge is, when do you buy? What do you buy? And for now, until there's a little more clarity, investors are just wait and see approach, as are we, because of the challenge. It's kind of the old saying, Gene, our mentors say, when you're in the falling knife category, it's hard as things are declining to buy because it could get a lot cheaper in the short run. As you wait for the turn, being the second one in, there's still a lot of upside ultimately, to invest in the markets. And we did similar investing strategy during COVID, where you kind of barbell a little bit with your portfolio, have the safety of cash, keep a diversified portfolio, and keep the flexibility within the portfolio over time. And again, when you look at near term, it's hard to see a lot of catalysts overall. And other things we're looking for near term, David, right, is some fierce selling, which despite kind of the big drop in the markets over the last few days, you haven't really seen a lot of panic selling within the markets at this point. But usually that's a near term, catalyst to have a short term bottom as well.
Yeah, I mean, we look for that type of activity. We've seen the markets come down with very rapid pace, right? So for the last couple of days, so a lot of investors, I don't think, have been in a position to fully reassess and readjust, and that could still be coming. So that's one of the things that we're watching for. But then you start looking at different types of actions that countries will be taking, and the Federal Reserve as well. So as as the economy potentially starts to slow, you can have an easing monetary policy, lower interest rates, which in the long term, could benefit small companies. But again, we've seen those be the ones that have taken the brunt of the impact in the last several days. And they're, again, like you said, JR, a leading indicator. So we'll be looking for some of those smaller companies to start stabilizing as a market or as a sign of the market starting to turn a little bit.
Yeah, and David, as you alluded to, right, what do you look for near term, right? And as you said, small cap companies, because they're not as big and liquid, they fall a lot more than the rest of the market near term. So normally, as you said, when things stabilize, you could still have the rest of the market falling, but small companies tend to turn up, prior to that. So that's a sign to look for. Other things to watch for is kind of that fear selling day, Federal Reserve actions, you know within the market. And in general, when the Federal Reserve steps in for any emergency action in the short run, tends to be a catalyst for a near-term rally. But historically, it's time to potentially raise a little more cash, because of that, because if the Fed stepping in, they're likely concerned about near-term growth or other aspects of the economy, and typically, you see the markets go a little bit lower after that. Other things to watch for, as we've said over the last few weeks, when you look at company outlooks, they're likely to be pretty grim, overall. So on the one hand, that could be a concern looking at earnings season starting Friday and the next few weeks. On the other hand, it's kind of chicken and egg. So one thing to watch for as well is when the company outlook is pretty grim, but the stock actually goes up on the news, you'll say it doesn't make any sense. But the reality is it's kind of priced in the market that the grim outlook is not nearly as bad as the drop in the underlying stock price. So you look for some of those signs as well that, the selling or the value within the market is there. And again, these will be things that historically, when you're in sort of a crisis or a big drop in the market, that are signs to look for the stability or, other actions within, like I said, the Fed or other countries or any kind of tariff news as well to give some more clarity or some time within the markets at this point. So David, as you kind of look through, kind of portfolios, I think, as we've really talked about over the last 6 to 9 months, diversification is very helpful in a market like this. As difficult it is to watch your asset prices decline in portfolios, fixed income for the most part has held its own and done very well. So as you're looking for protections within the portfolio, having that cash flow and safety within the portfolio has done its job this time around as well. And other things I think, in stressful times like this, is looking at the cash flow within your portfolio. So in many cases that's unchanged or actually goes up a little bit in times like this. So again, I think as you reassess what you should do with your portfolio in times like this is, number one, not stress too much, because it's hard not to, just given the declines overall. But it's really reassessing, am I okay from a cash flow standpoint, or one-time big purchases that you plan to make or need to make overall. And then within that, it alleviates some of the concern of the decline in asset prices overall. But it's, at this time, like I said, plan is to have a little more cash within the portfolios to protect, like as we've had coming into this, and kind of reassess and move from there, because there is great opportunity within the markets. And again, I think as a reminder, when we were in COVID, one of the first areas that we invested in during the lockdown were restaurants. And at the time, many people are, why are you buying restaurants, right? They're all closed. There's nothing, right? And that's where a lot of the opportunity was. So at times like this, you assess, where the likely opportunities will be, but you need some cash within the portfolio to take advantage. And like I said, more importantly, when you assess your individual situation, keep the diversification, right? And have the safety and make sure your cash flow is in place. And like I said, we can walk you through a lot of those conversations as well to make sure and adjust things. Because again, these are going to be stressful times. The markets are going to remain volatile for the near term, is definitely the market conditions we're in for now. And it's really making sure that you have the proper diversification and cash flow to ride things through, because it's, like I said, likely to be a difficult period for a while at this point. So with that, I want to thank you for tuning in. And like I said, feel free to reach out and, we'll be trying to put as many recordings or thoughts as we can near term as conditions change because, things are moving very quickly. And, by the time you watch this recording, there might already be, news or changes within the markets that we need to address. So with that, we'll touch base soon. Take care.
Thank you.